In this video, we'll talk about a technical analysis pattern called a flag. Flags come in two flavors. They come in the bullish and bearish flag varieties, but they're also pennants, which some people think of them as being different. I think of them as essentially being the same thing. It really comes down to a particular part of the pattern, but at the end of the day, it tells you the exact same information. So the first thing we need to do is define what a flag is. And a flag is essentially a run in one direction or the other, consolidation, and then continuation. The pennant is the exact same thing, and it really just comes down to, like I said, a particular part of the pattern as to what the difference is. Now let's take a look at the charts and try to find a couple of good examples, and I'll show you some of the unique qualities of this technical analysis pattern that so many people pay attention to. Okay, a couple of things that we will be discussing here will be the technical build of each one of these four patterns, but they're basically the same thing in multiple different directions. And I'll explain that here in a second. But the first thing that we need to think about is what exactly is going on when we see a flag. Now, the bullish flag suggests that we are going to go higher. So what this means is that the market might be going higher for a while. And then we start to consolidate. And then that's where the questions start. Are we just consolidating to continue to go higher? Or are we slowing down? The rules of trading a bullish or bearish flag will help you stay out of trouble here. So let me clear this off. And I'll show you an example on the chart as it formed. This is the US dollar against the Swiss franc, and you'll notice that the market had been rising for some time. And notice this big swing higher here. It's an impulse. It's an impulsive move. It's also what is known as the pole of the flag. Notice that we consolidated in a slightly negative channel, but slight being the key phrase here. And that's how you get a flag. It looks like a pole with a flag flying in the wind. What's brilliant about this setup is, number one, so many people pay close attention to it. It captures a lot of attention. But there are very specific rules you can use to benefit your trading. One of the most important things, in this case a bullish flag, is that it comes with this pole as a measuring device. So once you break above the channel, which is the flag itself, you are aiming for the length of the run up. Basically, you're looking for a continuation in the same size as the move to the upside. Now, how do we protect ourselves with this? Well, it's pretty simple. You wait for one of two things. You either wait for a break above this little trend line that makes the top part of the channel, or you wait for a candlestick that closes above there. Generally speaking, traders will either put their stop loss on the other side of the flag, or if they're a little bit more risk averse, they'll put it somewhere in the middle of the flag. And then, of course, they will aim for that move. It's not entirely uncommon for the move to actually extend beyond what the flag measures. There are some things that you need to think about when it comes to a flag. You don't want it to be a flag that's longer than a pole. You want it to actually look like a flag. But as I alluded to earlier, flags are both bullish and bearish, and they're not all that uncommon. It just comes down to, what's going on in the market if you have a nice trending market. So for example, here we have a very sideways choppy market, very, very difficult conditions for a flag to exist in, or at least a flag that you would want to be bothered with, is probably the best way to put it. So As I look at this chart, here is a perfect example of a bearish flag, although I would also point out that this trend line here in this channel was never violated. So it was a flag that never fired off a signal. And you can see that clearly we reversed everything there. Furthermore, as I just stated, I'd be a little bit cautious about trading a flag inside an area that is so obviously sideways for some time anyways. I am looking at the dollar against the Canadian dollar on a daily time frame, so that's actually several months that we are looking at. As I look through this chart, I see a lot of choppiness, and that's common for this pair, but occasionally we do get one of these flags. Here is another example. So this is a bearish flag, as you can tell by the trend line. And had you taken this trade, you would have had your stop loss either on the other side of the flag or somewhere in the middle of it. And regardless, you would have been fine and you would have hit your target pretty quickly and then some. And what I have found over time is, generally speaking, you actually get more out of the move. So one way that I will trade this at times is that once we hit that designated target based on the measured move of the pole, a lot of times I'll either take half off or remove my stop loss to break even, which is basically right at the flag, if we broke down below it. If you wait for a daily close below the flag or a candlestick close, this happens to be daily, then obviously your entry point in this case would be down here. So you would have to take that into account. So you have to keep in mind that very few things are perfect, and that's somewhat where the idea of pennants come into play, and they are a little murkier because pennants basically are flags, but instead of a channel, what they'll have is a triangle. So it's like a pennant, literally like a pennant. Has the exact same rules. So I don't typically get too hung up on a pennant or a flag. To me, it's basically the same thing. You have the same idea of a measured move and you have the same idea of a stop loss. So for example, here in the British pound against the US dollar, you can see that we hit that target pretty quickly. Really not a big deal. And that's not that uncommon. You can use this particular pattern on most time frames. I'm not real keen on the 1 in 5 minute type of setups, but on a daily kind of 15-minute, 1 hour kind of day trade setup, it does tend to work out fairly well. The markets, of course, are always random, so it's very important that you keep the idea of a stop loss and where you are wrong very much in the forefront of your trading, because if you do not, you can get hurt really bad in the markets. And that's not just this pattern, that's any pattern. So you must always pay close attention to it. You could, in this example, try to make out a bearish pennant, but truthfully, if depending on how you draw your trend lines, you probably could make a flag too. And you'll find a lot of times that's what happens. So in the British pound against the Swiss franc, on Friday, the 18th of October in 2024, you can see that we started to form this bearish pennant, and we did in fact break down pretty significantly and hit the target. We go ahead and get rid of those drawings. And I will take a look at another pair. US dollar, South African rand. This is an exotic currency pair, so it does get a little bit odd on shorter time frame charts sometimes. That is something to keep in mind. You want to, in the case of exotics, most of the time, try to find something to the effect of a higher time frame, because there's major issues when it comes to liquidity depending on the time of day. So here is a bearish pennant that you may not notice right away. Essentially, what you're doing at this point is you are trading a continuation that forms a triangle and then continues even further. Or in this case, an impulse, a triangle for consolidation, and then a continuation. The markets, of course, are somewhat random, and there isn't a whole lot you can do, but this is one of those patterns that a lot of people like watching and following. So there are traders out there that literally do nothing but this pattern. And with that being the case, you have to consider it at least part of your toolbox, or at least notice what's going on, because there are so many people that believe in this. This impulsive move by the Canadian dollar against the Japanese yen that is occurring right around the time I'm recording this could be thought of as a pennant or a flag. But either way, we broke out of it, and although it remains to be seen, the measured move of the pole for this bullish pennant suggests that we could go to 114 yen. Whether or not that ends up being the case remains a completely different story. But again, you just remember, nice impulsive move in one direction or the other, and then you're looking for consolidation in the form of a slight rectangle going against the impulsive move, just ever so slightly, or some type of triangle. Some traders will bicker about whether or not an impulsive move and then a perfect rectangle ends up being a flag. I think at that point in time, if it breaks down, it doesn't matter if you call it a flag or if you call it a significant impulsive move followed by consolidation, followed by continuation, because some people are real sticklers for that. At the end of the day, it all means the same thing. And really, your job as a trader is to just simply listen to what the market's trying to tell you and then take advantage of it.